Well, thank you. First of all, it is always energizing to be in a room with small business owners. So I want to thank you for the invitation, because it is one of my most favorite things to talk about is small business. And Todd and I today are going to talk about a couple of things that we think are really critical to small business. First is current and pending legislation. I know you're really excited about all of that. And then also some opportunities that you will have to really make your voice heard in Washington and even set the small business agenda going into 2019. As small business owners, I think we really wear a lot of hats. So I like to say that I'm the HR director, I'm the vice president of sales, I'm the production manager, the bookkeeper, and I'm even the facilities manager, which means I get to take out the trash and the recyclables once in a while, right? Anybody with me? Yes. All right, so it is really complicated and difficult for us to keep track of all of the legislation that affects us. In fact, I would say it's nearly impossible. Even with great resources, it's impossible to stay on top of these things. Now, if you're a large company, you've got staff, you've got resources, you've got people who are watching things. They are thoughtfully looking at what's happening with legislation, and they are telling you the exact time to exert influence, right? As small business owners, we don't have that luxury, but we do have help. On the national level, NSBA has got your back. So NSBA works in 4 areas that are really critical to small business, and I'll just kind of tick them off for you. So there's health and human resources, there's economic development, there is the environment and regulatory, and then the final one, which is one of my favorites, and I'm sure yours too, is taxation. So when we look at a small business issue and say, are we going to take this issue up? We look at a couple of things. Is it really a small business issue? Because there are some issues that are really, pertain to all businesses, large and small. That may not be something we want to concentrate on. We want to focus on what's best for small business. Second one is that we are member-driven and nonpartisan at NSBA. And so what are the issues that our members care about? Those are the issues we want to concentrate on. The third one is one that I really love, because it's one that we as small business owners live and breathe every day. We know we can't win every fight, right? We know we have limited resources. We can't do everything. So the other filter is, as we're looking at issues, is this an issue where we can make a difference? Because if it's an issue where we can really make a difference, that's where we want to put our time and attention. And taxation is one, and Todd's going to talk about it. We have spent a lot of time working on taxation, and obviously everybody wanted comprehensive tax reform. That's not what we got. We wanted parity for small businesses and pass-throughs. Okay. But there are some things that I think you need to know about, so I'm going to let Todd talk a little bit about that, and we'll talk about some of the other things as well.
Thanks, Cynthia. Primarily, I want to focus on this tax bill that just passed, what's in it, what's not, what the challenges of the future might hold, and what you might want to think about in your own businesses. But I think it's important to kind of go back in time a little bit and talk about how we got here and why. We've been an advocate for comprehensive tax reform, which means really taking what we have and throwing it out the window, putting something else entirely new in place for many years. And we came to that point because we became convinced that what we have is just fundamentally broken and can't be sufficiently fixed through the kind of reforms that we just saw. Mostly we got to that point because of the overwhelming complexity of the code, as much as the actual amount of revenue flowing out of small businesses' pockets into the Treasury. But after the politics of the last few years, I think it became increasingly clear to everyone that we simply weren't going to see the kind of comprehensive, pull it up by the roots and replace it kind of tax reform that a lot of us wanted to see. And a lot of momentum began to build behind corporate tax reform. The largest corporations in the country really had been able to galvanize the leaders of the country and to convincing them they needed tax reform. The main tool they used to galvanize that support was by basically taking all the money offshore. and by even taking their corporation headquarters offshore and saying, you know what, if you're not going to play ball with us, we're not going to play ball with you, and you're not going to have our tax revenue anymore. And that really was what Congress and the Treasury Department were looking down the barrel of, was company after company essentially leaving their shores, not necessarily in all their production, but in their headquarters. And today there's hundreds of billions of dollars, maybe it's trillions of dollars, in money that is kept offshore that is not repatriated because they were unprepared to pay the taxes. So it became a reality that there was a lot of momentum building for corporate tax reform. And I guess this is the first, success that I'd point to. And that train was really beginning to move. And small business was about to get left behind. And we were able to say, hold on, you're not doing just corporate big company tax reform. You're doing tax reform, you're going to address our needs as well. And that was deeply frustrating to some of the biggest companies in the country, but I think we were, over the period of the last 5 years or so, we won that political argument, and Washington came to accept that, yes, if we're going to do something for the big companies, we got to do something for the smaller companies as well. So that kind of sets the stage for where we kind of arrived this year, and the elements of that fight kind of continued through this year, because doing something for small business and for individual taxpayers costs revenue. That costs them money. That's not going to be in the Treasury. The big companies were worried they're not going to be able to get their rate down as far as they wanted it to go if they accommodated small companies. So that's been the sort of the backdrop of the whole debate over the last year. And I'll say right now, we ultimately supported the tax bill. But we also had reservations about it because it didn't do some of the things we wanted it to do. The major piece, both in terms of what the policymakers were trying to do and what costs the most money, if you want to put it in those terms, in the bill, was the corporate tax rate reduction from a maximum rate of 35% to 21%. And that, I think most of the larger corporations that have been looking at going offshore, it's convinced them to stay. It's definitely going to have an intended effect in that regard. So I think most folks would count that as some degree of a win. There's a lower tax rate yet for repatriation. I talked about all that money that's sitting offshore that hasn't been brought back domestically. There's an even lower rate of 15.5% for that money to be brought back. So if corporations bring that back, they'll get taxed at that much lower rate. Most of them say they're going to do that. So there's going to be a pretty significant flow of liquidity into the U.S. Markets, and companies are going to have cash to spend, essentially, or save. So that's probably a pretty good thing for the economy. The other big thing that was a significant source of a fight this past year was essentially increasing the bonus depreciation that companies enjoyed to 100%. And the original drafts of the bill that you may have seen allowed companies to fully deduct many of their previously depreciable items 100% in perpetuity. That's not what was in the final bill. The final bill does that through 2023, until 2023, and then it begins to scale it back again. One of the reasons for that was they partially paid for that increased ability to immediately deduct those expenses by reducing, in earlier drafts, dramatically reducing the ability to deduct interest. And interestingly, that deduction of interest would apply to all businesses, not just the ones that were getting the increase in the ability to deduct. So basically, small companies that use 179 expensing, which most of them do, wouldn't have seen any additional ability to deduct those expenses, but they would have had a distinct loss in their ability to deduct their interest expenses for buying those things. So it would have been a net negative for small companies. And so that was a fight we got galvanized on, and ultimately I think won, in that there is not that elimination for small companies of their ability to deduct their interest. And the larger companies lost, because ultimately that ability for them to increase their depreciation goes away after 2023. I raised 179 expensing. The other big win for us was we increased the ability of small companies to immediately expense those equipment purchases from $500,000 a year to $1 million. And then the final one that I'll call your attention to is cash accounting. Many more companies can now elect whether or not to use cash accounting, which is much simpler for many companies, and also can give them some upfront financial benefits. So that's a big one for many small companies also. You'll notice the one big area I haven't discussed is pass-throughs. And that's the one that got a lot of attention last year. It was a big focus for us because one of the primary things we were looking for in this tax package was parity for small companies. We didn't think it was sustainable to have a significantly disparate rate between what C corporations paid and what pass-through entities paid. And if we're going to, right now, previously they were at 35 and 39.6%. Those are pretty close. But with the C corporation rate going all the way down to 21%, we thought it would create some strange incentives and some real disparities to have pass-throughs going down much less than that. So that actually was the single biggest fight over the last year. And I would say our results at the end of that, I would put as mixed, honestly. Because we did get a deduction for pass-throughs, so they can deduct 20%, generally speaking, of their qualified business income from their personal tax returns. So that gets down for most companies in the range of 29 to 30% would be the top maximum tax rate, compared to 21% for the C corporations. The problem is, I say for most, because there's a lot more complexity embedded in getting to deduct that 20% than most people, I think, realized at the time the bill was passed. There's going to be one of the first tasks for the IRS, they just announced last week, is going to be trying to find ways to make sure that no one's gaming the system. So there's going to be an increased level of enforcement to make sure that people who don't deserve that 20% deduction aren't getting that 20% deduction. So it's an area that I think is going to be ripe for audit and a lot of oversight from the IRS as we move forward. So I think that's a really key area that people need to look at. And I say that because there's two main elements that you have to look at. One is, depending upon whether you have income that's not from your business, there are certain rules that apply. You also have to qualify what your own compensation was in terms of wage income from your business, and that's not counted as your qualified business income. So there's going to be a lot of analysis of whether you're paying yourself, if you're a pass-through, an appropriate level of income. Those rules are already in place, as many of you probably know, for purposes of paying payroll taxes, FICA, Medicare taxes. But we're now talking about a much bigger pot of money than before. So I think it's going to draw some IRS attention. So that's, in a very broad brush, what the tax bill did. And so you're saying, well, okay, is that a good thing for me? What happens now? When you step back and look at it from 30,000 feet, what you see is, yeah, most small companies are going to get some level of tax cut. And very, very few. You're going to have to be a very strange bird, I think, to see an increase in your tax bill because of this tax bill just passed. So for most small companies, it's a good thing in terms of how much they pay in taxes. But the other pillar of our tax reform advocacy is simplicity and simplification and enabling small companies to understand the taxes they're paying, to be able to plan in their tax payments. And there, I think we can safely rate this as something of a failure. It does not do very much at all, aside from the cash accounting piece, to make life simpler. In fact, a lot of these rules around how you calculate your income for pass-through entities is almost certainly more complex than it was before the bill passed. The other thing to bear in mind is all of these things that I mentioned around pass-through entities, the 20% deduction, expires in 2025. The corporate rate reduction is permanent. Unless Congress acts, it stays in place forever. But for pass-throughs, in 2025, that 20% evaporates if Congress doesn't take action to keep it in place. So that means if you're a new company that's coming online today and you're thinking about, okay, what formation should I use? Should I be an LLC or a C corporation? I think the calculation today is very different than it was a year ago, because if you decide you're going to be a pass-through, you have a very high chance of having a much higher rate than a C corporation in just a few years. And you also have this added complexity, which means you really can't be sure of what your rate would be even if they keep these current rules in place for many years. So I think in '86 we created significant incentives for companies to move away from C corporation status toward a pass-through status. And over the last 30 years we've seen a dramatic increase in the ratio of companies that are pass-throughs of one variety or another. I think that's very likely to begin to reverse. I'm not sure, it's anyone's guess, I think, at this point, how dramatic the move to C corporations is going to be, but I think it's indisputable we will see one, just because the incentives are there. But if you haven't talked to your tax advisors about this yet, I advise you to do it sooner than later. The other thing that I think is really important to think about is if you either are thinking about buying new equipment or increasing capital expenditures in your companies in the next few years, or you're in a business that's selling those things to other companies, investments they might make, there really is a big shift in incentives here. If you're selling primarily to really large companies, they have a big incentive to really stack their investments in the next 5 years, because they have huge incentives. They're going to go away in 5 years and begin to dramatically scale back. You should ask your tax advisors to look at that from the perspective of what it is you're selling and or buying, because the rules around those depreciation rates have changed. I mean, there are investments that weren't allowed for bonus depreciation before that are allowed for bonus depreciation now, and vice versa. And remember that key date, January 1st of 2023. The unlimited expensing for the large companies, or really all C corporations, but primarily larger corporations, goes away. The increased 179 expensing for small companies does not go away. It remains in place. So that's one piece of good news. But if you're not selling to those small companies, it's not such a good piece of news for you. So I think that's an important thing to bear in mind. I think we too often in Washington talk about these tax incentives in terms of how it affects the company's direct bottom line on their taxes, and not enough thinking about how it affects their customers. And that's a really crucial thing, I think, for you to bear in mind also. Think about all of this from the perspective of your customer. The final thing, which wasn't really bound up in all of this, so I kind of kept it to the side. It may not affect all of you, but I also wanted to point out what happened with the estate tax. There was some hope that it might finally just get repealed and we could end all this endless debate over the estate tax. Did not happen. The estate tax exemption level was doubled temporarily. So that doubling goes away in 2025, like all the other changes that I talked about in terms of the pass-throughs and all the other individual changes. The other thing I should mention that I guess I didn't specifically mention, because it's not just a small business issue, but the individual rate reductions that are part of the bill also expire in 2025. So not only if you're a pass-through, not only does your potential deduction from your income for being a pass-through go away, but the rate at which you pay on the remaining income is going to go back up again. So for people who own a pass-through, barring congressional action between now and then, they'll see probably a significant tax increase in 2026.
So I wonder if maybe we can talk about two additional pieces of legislation and rules that I think a lot of business owners are not aware of. There is the True Incorporation Transparency for Law Enforcement Act, or title, if you would prefer. How many of you understand the concept of beneficial ownership and what's happening with that? Essentially, this is an effort to catch bad actors who are using small business entities to either finance terrorism or launder money. Now, what's interesting about this one is that it's targeting companies who have 20 or fewer employees. Often small businesses are used to legislation of 50 and above. This is actually targeting small companies. What this comes down to is there's a Section 9 in there that says if you have a change in the beneficial ownership of your company and you don't do the reporting process within 60 days, you can be charged up to $10,000 and be subject to 3 years in prison. Yes, I can see the looks on everyone's faces. I was surprised too when I heard about this. So think about it. You have a business partner who gets divorced and their spouse gets an ownership in your company. You're not aware of it. You don't file the paperwork. You can be subject to a lot of litigation. So this is really targeting small businesses. And the other piece of it is the reporting. There's questions about privacy, and there's additional concerns too, right?
Oh yeah, there's huge concerns. I mean, think about companies that may get private equity capital, for instance, or crowdfunding sources.
Yep, crowdfunding.
You may have, through crowdfunding, you may have a significant number of owners in your company that you have to report on their ownership, and then any changes to that ownership that they don't have to tell you about within 60 days, or you would be in violation of the law. The other thing that I'm really concerned about is there's a lot of potential here of just shipping a bunch of data off to FinCEN, which is a Financial Crimes Enforcement Network, which is part of Treasury, that the FBI or even local law enforcement could use on a fishing expedition. They may have something out for a company, they want to get them on something, and they can't show the charges they want, but they might be able to find a reporting error in their beneficial ownership requirements that could send that company to prison, and that business owner to prison for that violation. Well, that's a pretty significant thing to hold over their heads while you try to get something else out of them, right? So it creates a significant leverage against smaller companies for what might otherwise be a really minor violation. So we're pretty worried about it. It's been floating out there as an idea for a long time, but it's getting much more significant traction lately. So keep your eyes on that.
Okay, do I have time for one more quick one? Net neutrality, if you don't know, FCC changed the net neutrality regulations as of December. This can be a significant issue in terms of access and speed of internet. We think there's probably going to be a challenge to that. But one of the things that we do know is that the courts tend to favor the agencies that have jurisdiction over these things.
Yeah, although I really think if net neutrality gets changed again, it's almost certainly going to have to come from Congress. I mean, I think there will be some attempts at some lawsuits, but most people don't think that those are a likely route. So I think congressional action, I think there'll be some attempts at it. It's anybody's guess how that shapes up this year, though.
Yeah. So last but not least, there's a couple of opportunities. In June, there is what we call a fly-in to Washington. SBAM often brings people. If any of you are interested in knowing more about that, it is a terrific opportunity to come up to the Hill, get some education about how to go and lobby legislators, meet some terrific business owners. We'd welcome all of you to come and do that. There's also the opportunity for you to come to the Small Business Congress. That will be at the beginning of 2019. We'll pass information along. And then finally, issue committees. If people want to be involved on the issue committees of NSBA.
It's one of the benefits of SBAM being part of NSBA. We have issue committees that are along the lines that Cynthia already outlined. There's 4 groupings, and we have quarterly briefings and Q&A sessions for these folks that have been really well received. We have some really high-level speakers on these calls, and any member of SBAM these are open to all of you. So if there's any of you who would like to participate in, let us know. Maybe Mike is the right person. I'm not sure who the right person to let know is, but and we can get you on the list if you want to. You can call in and listen on the calls and participate. Would love to have your input.
All right. Thank you. All right.